It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. It's Ferenc, and I'm going to do something a little different than I do typically. Like I've often said, most of my clients, and myself included, when it comes to investing and, looking at money, we're looking at the longer term. The short term, intermediate variations of the economy, interest rates, the stock market, all those kinds of things, are not something to pay a lot of attention to. Again, we're looking at the longer term picture in most cases. But like I said, occasionally, I've been in the financial industry 22 years. I remember the dot-com run-up. I remember the 9/11 cycle, the next run-up, the 08-09 cycle, of course, and, this more current the bull market we've had for the last decade or so. And then, of course, occasionally, every once in a while, something happens or events occur that get your attention. And I would say this last few weeks here have gotten a lot of people's attention. And so I'm going to share some ideas, some thoughts, some opinions about what, the certain current, the volatility. I think that's a safe term. Lots of volatility in the markets. Interest rates certainly have dropped again. The Federal Reserve dropped had an emergency meeting, dropped the rates a 0.5 point recently. There's talk of them doing more again as we go forward. So I think what it boils down to is the recent events, and, of course, a lot of people talk about the coronavirus and various things. There's a lot of reasons above and beyond just that, why the markets are the way they are, the volatility that's occurring, the economy. There's been trade war talk. There's been, there's concerns about, uncertainty with the election in terms of, later this year. There's a lot of the factors, a lot of folks think that the market is lofty in its valuations. I mean, there's a lot of reasons. And, we've had, no question, a long, extended economic boom, including a stock market. Now, not everybody's benefited from it. There's talk about that, of course. My thing is, I'm an optimist in general. I've been in the industry, like I said, over 22 years. I've lived and been part of several cycles. Have been a real estate investor through this period. I'm in the process. I'm the chairman of the board of a bank in formation. So, of course, own and am in the financial industry, deal with a lot of safe money things. We talk a lot about your personal bank. That's the focus of this show. I've talked about other topics like annuities, for example, for, safety and things like that. Again, what is it? What I'm going to do is try to keep a balanced thought here, not to get too excited, but not at the same time gloss over a lot of stuff that's going on. And I think the thing is that one point that kind of comes across to me, and again, this is how I feel. There's an article that came out, one of them that got my attention first from Washington Post. And there's a bunch of more articles that have echoed that sentiment since in the past week, but this time it feels different is the title of the article. And what I mean by this time it feels different, again, the markets go up, they go down. There's a lot, the economy, there's interest rates, all those different things change. But every once in a while, like I said, an event occurs a series of events occur that makes it feel different. And I think at the very least, it'd be fair to say, again, from my perspective, my personal opinion on this, and I think a lot of the articles I read kind of echo that, especially these days, this is a tide change or a sea change, at least, in terms of, like Jim Cramer recently just stated that, these events could be the end of the bull market, okay? That's what it feels like. Now, is it? That, that's nearly impossible to predict. The problem is it's really, people say it's extraordinarily difficult to predict where the markets are going to go, what direction it's going to go, up, down, or sideways. So it's really more of a perspective thing and what people think and feel and, the events and activities are going on. So my point is this, if this is indeed a sea change or a tidal change, if you will, in the overall direction of the market, is it a shorter term thing? Is it a longer term thing? Is this the beginning of the next cycle, let's say? Are we going into a recession? Those are answers that nobody has right now and no one knows. But here's my point I want to make is this. People tend to make decisions and changes. That's human nature. We do that when crisis occurs, when things happen, okay, to cause us to make those changes or whatnot. And of course, like for perfect example with our health, if somebody's has poor health and let's say they have a medical situation occur and, the doctor says, look, you've got to change your diet. You got to change your exercise. That's when people tend to make those changes. When life is going along and everything's hunky-dory and, it's all good, we don't tend to make changes. Again, that's human nature, A lot of times something external has to come out and prod us into change, if you will. And so a lot of people will change their diet and lifestyle when that medical crisis occurs. Well, there's no question there's lots of volatility. There's been a lot of people call it panic selling and various things out there, the different perspectives. Let me put it to you this way. I think the one conclusion I've come from, I've read a couple hundred articles, radio shows, blogs, TV, various things. There really is no consensus right now. You read one article, for example, and they'll talk about, doomsday and, the end of the world's coming, so to speak. And others say, hang in there, it'll get better, and, buy on the dips and things like that and be optimistic. So there's very pessimistic, there's very optimistic views right now, which is kind of par for the course. Like I said, if I go back in my experience, history, in this, I've seen two previous cycles where things changed from a, upward trending, bullish economic and the economy and the markets and things like that to where it went into recessions, 9/11, 2000, all that was one of those, 2000 to 2002, of course, known as the dot-com bubble, and then the dot-com bubble burst. Then, of course, 08, 09, most people remember that one. A lot of us do. And there were definite sea changes, if you will, in the directions of the economy, the market, interest rates, all of those things, right? So, again, if we're at the beginning of one of those things, it certainly makes sense. Let me put it this way. I don't know if we are or not. It's too early to tell. But it certainly makes sense to take a look, analyze where you're at, and perhaps make some adjustments. Because if indeed the tide has changed, then you want to make sure that your portfolio, your investments, what your focus, what you're doing, you want to adapt to that change, okay, and be just cognizant of it. To ignore it, I think, is unwise and not practical. To panic, I don't think that's wise either. Okay, you want to be strategic about it, and just realize that the possibility is definitely there that we're looking at certainly a change in direction. And it could be something worse or bigger or, the next, the possibility of a recession exists. And to deny that, I think, is being disingenuous. Just be prepared for it. Don't panic, but be prepared for it. What are you doing with your money to ensure that if indeed we are going into the next cycle or recession or adjustment, correction, whatever it ends up being, are you prepared for it? And one of the things I'm going to refer to, and it's kind of interesting, and I've got a lot of experience with this with a lot of clients, there's a Vanguard study that came out recently, and it was talking about how, the past, again, the last decade's been extraordinarily a good, strong, long bull market, and, the traditional mix of a lot of people talk about using 40%, no, 60% equities, 40% bonds. It's sort of the standard rule of thumb of everybody's situation is different. Hey, here's something I always talk about. Look, there's some people 100% in stocks makes sense for them. And other people 0% in stocks makes sense for them. A lot of that depends on your financial place, stage of your financial life you're in, your risk tolerance, your personality, your experiences, if you've had great successes or you've been burned in the past, that's going to impact emotionally how you feel about risk. There's a lot of things that impact risk, folks individually. So when we say 60-40, I think that's an overly simplistic recommendation, but again, a good general rule of thumb. I'm going to talk about this Vanguard article and how folks have let themselves kind of get overly exposed or off of that normal traditional mix and allowed to be heavier in stocks, which has worked for the previous decade or so, but may not going forward. Let's talk about that more in the next segment.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com.
I want to invite you to a very special event. We're going to invite 8 to 10 people to participate in recording a Your Personal Bank show at the Money Radio studio. This event will be on Tuesday, March 24th at noon. If you're interested in joining us, contact us at yourpersonalbank.com. Remember, there's only 8 to 10 seats available in the studio, so hurry and get registered. We'll see you Tuesday, March 24th.
Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're talking about a lot of things in terms of the economy, interest rates, the markets, all those kinds of things. And again, as I stated in the first segment, that it's not something you pay attention to a lot in the day-to-day, week-to-week, even month-to-month gyrations of the economy and things like that. But again, situations happen, series of events occur that it's wise to pay attention to and look at the situation with a bit of a strategic view and understand the different possibilities that it could occur. I mean, I've read numerous articles and various things, and right now there's really no consensus in terms of where things are going, what's going to happen, particularly if you talk about the stock market or interest rates for that matter. Or any market. There's a lot of questions about gold and precious metals and all these various other arenas, the cryptocurrencies. And there's a lot of volatility. And volatility, basically, in a nutshell, the simplistic view of it is, look, it's a lot of push and pull, which means it goes up, it goes down. It doesn't have a real direction, and the majority hasn't decided yet. So there's a real push and pull, or in other words, uncertainty. Now, this uncertainty causes emotions. A lot of times, fear. There's fear and greed. It's always talked about as the primary emotions that motivate investors. My wife always reminds me, she's a postmaster's degree in social work and a lot of human behavior involved with that. And she always tells me, look, emotions, although they may not be logical, they're real for the person feeling the emotion. So if somebody's feeling fear, for example, or greed for that matter, or any emotion, it's a real feeling. And so with volatility occurs a lot of fear in the markets. And you hear, some of these articles, some of them get, out there. And I'm not saying I agree with this, but what I am saying is it speaks to the level of fear that occurs. I've seen some articles talk about we're going into another Great Depression. Again, I'm not saying that I agree with that, but it is definitely speaks to the level of fear that can be out there. And one of the things I share with people all the time, and having the right balance of, if you will, safe monies, a portion of your assets or investments that are safe. It's nice to have assets that are guaranteed. I use a term a lot of times I call non-correlated assets. And what is a non-correlated asset? It's an asset where the price or value of that particular asset is not, the factors that affect the price and value are different than the factors that affect the other asset. So a great example is, if you have a market-related asset, subject to market risk and various things, it can be affected by market and economy factors up and down. Where you have, like I talk about the personal bank a lot, I've mentioned annuities at times, a fixed annuity or a steady Eddie guaranteed return personal bank, one that has some guarantees built in terms of the returns and how much it earns annually, that can be a non-correlated asset. In other words, those kinds of assets can grow every year, irregardless of what the markets do. And, traditional modern economic theory has stated, you should, general rule of thumb, 60-40% split in equities and bonds, for example. That's a very common rule of thumb out there. Now, whenever I hear or see those kinds of recommendations, of course, I hope most people recognize that's a very simplistic or generalized view and may or may not apply to you. Your situation could be very different than what they're talking about would be a good fit. For example, what's your stage of your economic or financial life? Somebody in their 30s, certainly in most cases, would probably have different economic and financial needs and focus and goals than somebody in their 60s. Now, today, actually, age can have less of a factor in that sometimes because, we've all heard about, or many of us have heard about the FIRE movement recently, and it's taking on some interest. The FIRE movement, if you don't know what that is, it's financial independence, retire early. So FIRE, FIRE. And although I absolutely applaud somebody's focus and goal becoming financially independent, many times at a fairly early age, retiring early may or may not be a great fit for that person. Many people get a lot of their satisfaction in life and such based on, what they do. Not that it should define you, but you gain some satisfaction and a feeling of usefulness, if you will, having something to do or accomplish, or you have a passion. And that's awesome. I have a passion for sharing the personal bank concept. And if you've heard this before in other shows, you know that why I share it, although our company and myself, we do many other different financial products. We talk about the personal bank concept because I find, in most cases, very, very few people have a familiarity with this, and in many cases never even have looked at it. And although I'm not saying the personal bank is a tool that every person should use, I do feel strongly that you should at least certainly consider it or look into it to see if it's a financial tool that could benefit you. I said in the last segment, as far as how much you should have in stocks or whatever, or risk, let's put it that way. Stocks is sort of, in my opinion, kind of a narrow focus. I mean, I have a lot of clients who have nothing in the stock market, but they have risk because they own businesses or they're in real estate investing or other forms of investing out there. There's many different types. So it's really more about your balance or your risk tolerance, if you will, of how much of your investments, your portfolio, what it is you're using are at risk versus how much are at lesser or have guarantees. So when it comes to that 60-40 rule of thumb, if someone gets nearer retirement, it's often recommended to be more conservative. And, that's not necessarily bad advice, okay? My point is that 60-40 may or may not fit. Like I said, there's some people 100% at risk makes sense for them at that time, and others where 0% at risk makes sense for them. So it can be that much of a swing, and it could be the same person at different stages of their life, by the way. Again, it's all about risk tolerance, where they're at in their financial stage, what their experiences are, what they feel comfortable with. Have they had great success in the past with certain things? Or have they been burned by other things? There's so many things that come into play. It's an emotional response. But what I'm getting at is this Vanguard article I was starting to refer to. It's talking about how many of the Vanguard investors, they did a poll, a study, have, in the last few years in particular, really kind of let their stocks run long, if you will, their investments, because the stock markets have been really strong for quite some time. And for the last several years, of course, that's, actually worked out okay. It's worked out great, in fact. So, in fact, I find this to be true, and many times with a lot of my clients or folks I meet with, they're overly weighted, heavily more so in risk investments, whether, again, stocks, the market, other markets, real estate, businesses, whatever it is. In other words, a lot more of their money's been at risk than maybe they would feel comfortable with, particularly in a not-so-strong market. Again, or economy or whatever. If our economy and our markets are taking a change in direction, which I think is a fairly safe statement, if you know what I'm trying to say. There's certainly lots of volatility. Is this short-term or is this longer-term? Again, too early to tell. But I think it's very important to recognize that there are definitely the possibility exists of us going into a recession. We have to recognize that, okay, and be prepared for that, okay? So whether it's a shorter or longer-term thing, it's a good time to take a look at your risk tolerance right now. How much of your investments, how much of your money is at risk to whether economic, market risk, interest rate risk, there's lots of tax risks out there, versus how much of it is reduced or eliminated from those kinds of risks. There are financial tools that can accomplish those kinds of things. The personal bank I refer to many times is one of those tools that can address many of those risk concerns. and can create, if we set up the right type with the steady, consistent one. We have index ones, options also. But my point is, if focusing on the fixed option for a moment, that's not subject to market risk. And that can be that non-correlated asset, or that bucket of money, or that percentage of your investments that is not going to be impacted by, say, a falling market or economy, or interest rates for that matter. It has guarantees built in terms of returns. And that's really important, to have that balance and make sure that balance is the right one for you, particularly when we're talking about uncertain times like these. Stay tuned in the next segment. We're going to talk more about getting things in balance and thinking of that tools that could be a bond alternative because of the extreme low interest rate environment we're in. Stay tuned.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back to Your Personal Bank Show. We're talking a lot about the uncertainty in terms of where we're at with the economy, interest rates, the markets, all those kinds of things. And, I'm not want to be a doomsdayer or anything like that. I just want folks to be cognizant of the fact that it sure seems like we're having a sea change, or change in the tide, if you will, change in direction. There's no question that the economy and the markets have been on a strong roll for quite some time. And the cause of that, or I should say, as a result of that, the Vanguard study I'm referring to that recently read and experience I've had with many of my clients is, where they were normally maybe started out a certain percentage of their money were in equities and some percentage were in bonds or other safe type money investments, that percentage has kind of gotten out of whack, if you will. The stocks have certainly let them run long, if you know what I'm trying to say. They've grown, they've gone up, so their percentage is higher than maybe what they would feel comfortable with. And especially in today where things might be a little different. And it's been okay because, rising tide raises ships, right? So it's worked out fine. But if things have changed, and we have to recognize the definite possibility that there's increasing evidence in terms of how, this is a change in direction. Now, how long? Is this going to be a full-blown recession ultimately, the beginnings of it or something? It's too early to tell. But we do have to recognize the possibility that it could be there, okay? We could be. I don't know. But nobody knows. That's the thing. We'll know down the road. The thing is this. It's a good time to take a look at your balance. And ask some really legitimate questions, okay? Is your balance in where you're comfortable? I mean, here's the thing. Your financial position might be, or stage in life, for example, might be different today than it was several years ago. Your financial position could be different. Your goals, your focus, things that, what you're wanting to accomplish might have changed, okay? And so the amount you have at risk versus not at risk may be different today. Plus, again, if we've got a change in direction with the economy and such, then that could be an impact. Now, if we talk about, the rule of thumb, we always hear about is 60-40, the modern economic theory, we hear about all the time, where 60% equities, 40% bonds. Okay, again, that's an overly simplistic view. And everyone's situation could be different, okay? It could be as extreme as somebody should have 100% in stocks, another person should have 100% not in stocks, okay? Because of their situation, who they are, their stage of life, their emotional, their risk tolerance, okay? It's an emotional thing, right? My point is, or anywhere in between there. My point is this. The problem is we're also in an extraordinarily low interest rate environment. Recently, the Fed had an emergency meeting, dropped the interest rates another 0.5 point, the federal funds rate, that is. So the federal funds rate, by the way, was, a few weeks ago, 1.5%. And by dropping it a half a point, they've dropped it to 1%. And I heard, and several statements I've seen, articles I've read, and they did that because, they were concerned about the economic activity and where the markets were at and coronavirus and various other things. Oil situation has gotten dicey. I mean, there's a lot of reasons out there. And, when the Fed drops rates, a lot of people pay attention. And I'm going to put my banker hat on for a minute. I am the chairman of the board of a bank in formation. Been doing a lot of learning, experience, knowledge, and dealing with the banking industry over the last year and a half or so. And the thing is, again, the Fed does this for a reason. I mean, when they're dropping or raising interest rates, they're doing it for valid reasons. So they have concerns about the economy. And, of course, that's, been reflected in what we've seen in the response to the markets and such. My point is this. It's kind of like, the best analogy I give you is the Fed dropping the rates from 1.5% to 1% is kind of like bringing a knife to a gunfight. In other words, is it going to be enough to really make that much a difference? And let me illustrate. If we go back to 2008, 2008-09 became the Great Recession. And when we went into that, the federal funds rate at the beginning of that was 5%. And within a year, the Fed had a series of interest rate drops, and it dropped it from 5 to less than a year later, it was at 1%. Well, when you drop the Fed rate from 5 to 1, that's a significant reduction in interest rates. So in other words, the cost of borrowing dramatically drops. It's a significant impact. So although we did have quite a recession and various things, the Fed did certainly have some impact. There's quantitative easing. There's other things they did, but they certainly had an impact on how they affected the economy overall and then led to the recovery that we saw. The problem they have here is we went into the beginning of this, this volatility session here or whatever it is, or like I said, short, long term, again, too early to tell. But if we are going into the next recession, and like I said, the possibility exists, we need to recognize that fact. To not do so, I think, would be disingenuous. You got to be prepared for it, of course. But my point is, if they're going in at basically it was 1.5% when it started, there's not a whole lot of room. So one person I heard say, one expert said, if somebody wasn't borrowing at 1.5% Fed rate, what's going to make them borrow at 1%? I mean, that's not a big difference. I mean, debt has been super cheap, super low. Interest rates have been really low on most debts. I mean, look at mortgages out there, car loans, various things like that. Many types of debt instruments are affected by interest rates. And the Fed fund rate is sort of that benchmark rate, if you will. Not that most interest rates, debt instruments are either directly or indirectly affected by. Okay? So, how much of a difference is it going to make? And we're going to see, but certainly they won't be able to have the impact on lowering rates that they had back in 2008 because they just don't have the room to run, you know what I'm saying, to drop those rates that much farther because they weren't very high to start with. So what that does, it brings up another issue, though, is we're in an extraordinarily low interest rate environment. The 10-year Treasury, for example, has hit new all-time lows, below 1%. When you're talking about Treasury rates below 1%, that means your fixed investments are making very low rates of return, or paying very low rates of return, I should say. Look at CD rates these days, and have been for a while, very low rates in comparison to, say, a decade ago or more. So if you're going to have that protection, that flight to safety, or make sure you've met that right balance like a lot of people are doing, with this extraordinarily low interest rate environment, it makes it really tough to find a safer type of asset that will pay any type of return. So I think that's where the personal bank, some annuities, fixed index annuities, some fixed index annuities with guaranteed income riders, for example, can fit that place or be that bond alternative. I've heard that term used by a number of advisors. I mean, just to give you a quick idea, I've shared this for quite some time. The personal bank, the fixed option, has a contractual guarantee credit rate right now of 4%. The current rate is 5% crediting. And, it's tax favored. There's some other benefits involved. You have access to funds. What if you put a portion of your funds into something like a personal bank where the money's growing at these days, in comparison to a lot of other fixed instruments, good rate. You have access to a majority of your funds. And then when the next cycle, if and when it happens, or you see a opportunity come about, or you feel like there's a bottoming of some prices on stocks or other investments, well, you have a pool of money or assets that weren't impacted by the markets, so they didn't participate in the downward trend, if you will. You'd have a pool of money that you could pull from and take advantage and buy on the dips or buy on the lows when they do occur, like a lot of people recommend. That's one way of using a personal bank to enhance future investing and get things back more in balance to where it's a better fit for you, particularly in a market or situation or economy that we're dealing with today. Stay tuned for the last segment. We're going to go into a little bit further, a couple other ideas in terms of how you can maximize returns and income.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com.
I want to invite you to a very special event. We're going to invite 8 to 10 people to participate in recording a Your Personal Bank show at the Money Radio studio. This event will be on Tuesday, March 24th at noon. If you're interested in joining us, contact us at yourpersonalbank.com. Remember, there's only 8 to 10 seats available in the studio, so hurry and get registered. We'll see you Tuesday, March 24th.
Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're rounded third on the Your Personal Bank Show, and I've been just covering some things about, the economy, interest rates, the markets, all those kinds of things. Certainly in a volatile situation recently. I'm not sitting here trying to say that things are going to be, I'm not saying we're going to go into a recession, but I do believe that the possibility exists and need to recognize that and prepare for it. Could be a short term, could be a longer term thing. It's too early to tell. But what I am saying is certainly it's time to take a look. It seems like and feels like more and more as time is going forward here. One of the articles I read, recently was like, got punched in the face. I thought that was an interesting title, talking about stocks and bonds and Bitcoin plunge and oil, after the price war with oil it seems like that's going to happen. Lots of things are going on in the economy and whatnot that are causing the markets to have the volatility that they're having. And again, no one really knows what's going to happen. We don't know how long this may last. There's just too many unknowns, too many variables, and too many factors going on. And the reality is there's certainly been some fear that has been attributed to some of this. And as my wife always says, as a behavior specialist, a human behavior specialist, fear is a real emotion. People feel it. It's real. Okay. So the point is this: be prepared and plan accordingly. And one of the biggest things, the point I want to make today is, the traditional mix of money that's at risk versus not. You hear in modern portfolio theory about the 60-40 split, which is, in my opinion, overly simplistic. Certainly doesn't fit everyone. But it's I guess it's a good rule of thumb to start with. Everybody's situation can be dramatically different. But the thing is, a lot of people, I've seen this with a lot of my clients. A Vanguard study I read just recently pointed a poll where, in the recent years, because the markets, the stocks have done so well, that folks have kind of allowed them to run and kind of allowed that balance to get out of balance, if you will, out of whack. And this is the time to start re-looking at that and saying, hey, am I in the balance? Do I have the percentage of my monies, my investments, whatever, in the safer arena, safer side of things? And bonds are usually brought up as a solution. But I get frustrated when I see all these things because there are other options. I'm not saying bonds aren't, what I'm trying to say is bonds aren't the only option. There are other bond type alternatives, if you will. Annuities certainly can fit into that category. So can the personal bank. Personal bank has The fixed option, fixed has guaranteed rates of return. You can earn a guaranteed rate of return each year. And frankly, compared to other fixed instruments these days, pretty darn good and competitive. So annuities can accomplish that. For example, if you're looking at creating an income for retirement, for example, there's a lot of annuities with guaranteed lifetime income riders. And I know several companies right now that are offering a 7%, for example, guaranteed roll-up on the guaranteed income rider benefit. What does that mean? If you put some money into one of these annuities with that rider, the money will defer, it'll grow it'll accumulate, I should say, at a 7% rate, and then you can turn on an income stream at some point in the future. And whenever you decide to do that. And your amount you're going to receive monthly as a guaranteed lifetime benefit, for example, is based on your age and the accumulation that account has grown. And with a 7% roll-up, for example, it means that account, or that income, I should say, that you're going to receive is going to increase basically 7% each year, that pool of money that you can then access funds from. Now, how much you get from each year is an actuarial calculation, like I said, but it is based on your age and the amount of money in that account. Well, if that account is growing at a 7% guaranteed rate, well, in a decade, those of us that are familiar with the rule of 72 understand that at 7.2% growth rate, money doubles in 10 years. So at a 7% guaranteed growth rate on that income account, the amount of money available for guaranteed lifetime income nearly doubles. Okay? So it's not subject to markets or economy or anything else. It's a contractual guarantee. Now, it's not an amount of money you can access cash and access and use at willy-nilly. It's to set up a guaranteed income. Why would that be so important? Well, for example, for retirement, supplementing a retirement, that can be very valuable. You can create a guaranteed monthly check that'll come in the rest of your life. And that can satisfy, for example, those known needs that we have in retirement. One of the tools that I use, or concepts I share with folks a lot with retirement, is, look, we're going to have a certain amount of money we're going to need to live on in retirement. Food, housing, clothing. Those are known needs. We can calculate what those are based on your current living standard, budget, whatever. Use a reasonable inflation factor and calculate with some reasonable accuracy how much you're going to need for the rest of your life, basically. Well, what if you set it up in one of these annuities with a guaranteed lifetime income benefit? You could lock in that known need, that income need, future income need, and not be worried about what the markets or the economy or taxes or interest rates or anything else are doing. You've locked that in. Now, could you then risk the remainder? Could you perhaps even take on a little bit more risk with the remainder? You could. And it's also, we know this, if you're going to, say, put that into a business or real estate investing or some other investment tool or the markets, there's various, even in real estate or the stock market or other places, there's various levels of risk on those tools. A startup company typically is going to have, for example, is going to have a lot more risk than, say, a well-established long-term blue-chip company, for example. And the same holds true in the real estate investment world or business world or any other investment area. So the level of risk that you take on your risk side can potentially you can have enhanced risk, but you can have enhanced returns. That's hopefully the purpose, if you know your guaranteed needs are taken care of. The personal bank can accomplish similar things because of the guaranteed growth that's built into the fixed option. So you'll have a return that is going to occur every year. So again, we can calculate how much money would be available, for example, at a certain point or for the rest of your life, for example, for those known needs. That's a way to balance the risk out and ensure that your needs are taken care of in the future, irregardless of what the current economy, markets, interest rates, or anything else are doing. And again, with the very low interest rate environment that we've been in for now quite some time, the last decade or so, there's our tools, fixed tools out there that still offer a reasonable rate of return so that you can get those known needs and those guaranteed needs or I should say those needs you have, you can lock them in and know that that money's going to be there. And I think that's what it's really about. What's important is if you are putting money away, investing or whatever for the future, typically for your retirement, eliminating that stress and knowing that I have what I need to take care of our needs for myself and my family, that takes a lot of stress off. And then you don't have to worry about so much about what's going on with volatility and everything else that's happening. Stay tuned every Tuesday at noon for the Your Personal Bank Show on 1510 AM or 105.3 FM. And if you want more information on any of this, please contact us at yourpersonalbank.com.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
Index annuities offer a fixed interest option and index interest options. Annuities with index options may be referred to as equity index annuities. The index options are not securities. You are not investing in stocks or in the indexes themselves. Credited interest does not include dividends paid by companies included in the relevant index. The credited index rate is linked, in part, to gains in any combination of indexes. You are not actually participating in the market or investing in any stock or bond. Index strategies may not be available in all states. Withdrawals may be taxable, and if taken prior to age 59 and a half, a 10% penalty tax may also apply.